Well, good news for those people, or rather some people with a mortgage. Less good, I guess, for people who are looking to save a lot. Earlier, I spoke to Rajan Lakhani, who's the head of money at the personal finance expert Plum, to get his response, his review, his analysis of the rate cut today.
Today's cut in the Bank of England interest rate by 25 basis points to 4.75% is good news, particularly for people who have a mortgage. So there are a number of different types of mortgage: fixed mortgage, tracker mortgage, or standard variable mortgage. And for those who have a tracker or standard variable rate mortgage, they'll see a reduction in the interest that they pay for their mortgages. So there'll be hundreds of thousands of mortgage holders today that'll be very happy about seeing the interest cut, and in turn they'll be paying less on a monthly basis. On the other hand, if you're a saver, it's not so good news because the saving rates that banks, building societies and fintechs offer are closely pegged to what the Bank of England does, and that influences what they can offer. And following the cut today, it's likely that a number of savings products that are variable will see a reduction in those rates. So savers won't see the same level of rates that they were getting before.
Looking at the bigger picture, though, there's still a long way to go, isn't there, with bringing interest rates down to something that is far more manageable for a lot of people, and also going hand in hand with what's been going on with inflation too.
Absolutely. So interest rate expectations have moved significantly. So at the start of the year, there was an expectation that there would be a lot of cuts in 2024, and that's not been borne out. We've only just had our second interest rate cut announced today. So things are moving slower in rates coming down, and inflation has taken longer to get under control. And now the positive news is it is below the Bank of England's target of 2%. So while a lot of people who had mortgages will have been hoping that rates have been coming down quicker, they'll have seen that that's not been the case. Now, what happens with rates moving forward? Well, again, those expectations are changing once again. So at the end, towards the end of last year, there were predictions recently that rates would fall to around 3% by the end of next year. Now that's been updated following a series of major events that have happened recently. The budget that was announced last week, followed by the election of President Trump, they will impact interest rate expectations, because there is now, following the budget, extra spending being made by the government, and that should create growth. And from growth, there's likely to be inflation. So that's, inflation inherently isn't a bad thing if it's happening for positive reasons. And if the increased amount of spending announced by the government on public services does deliver growth, and that does deliver inflation, that's not necessarily a bad thing in itself, but it does mean that interest rates will need to be held higher than might have been predicted as well. And then there'll be the ramifications of what Donald Trump does as well, because that's already having an impact on treasury yields. So this is the borrowing that the American government does, and those yields have risen, and in turn gilts, which is the UK equivalent of those bonds, the yields on them have started to have risen further as well, and that's having a knock-on impact on government borrowing rates, and that will influence overall the interest rates that the Bank of England offers as well. So you're seeing these impacts happening, and that will impact how interest rates move forward as well.
Well, if you were looking in your crystal ball, Rajan, how do you think the next year is going to pan out?
It's difficult to predict what's going to happen over the next few months. At the start of the year, there was predictions that there'll be cuts across the year, and we've only had two cuts so far. I think the key thing for someone is to make sure that you're prepared as much as possible. So if you have got a mortgage and you need to remortgage in the next few months, start preparing early. Speak to a mortgage advisor, understand what your options are, and then you'll have that flexibility. So if rates do come down quicker, then you can then move on to a lower rate. But if rates don't come down, then actually you've locked in a rate that is competitive now. So making sure that you are starting early, if you have a remortgage coming, will make sure that you've got a number of different options as well. And when it comes to saving rates, take advantage of those higher rates that are at the moment. So if rates, whatever happens, it is likely that rates will fall. It's just how quickly they fall is up for question. So by locking in higher rates now, you're making sure that your savings are getting that as high an interest as possible as well. And you've got a lot of competition at the moment. So you may look at your bank and see what the rate is, but actually there's banks, building societies and financial apps that are offering very, very competitive offers as well. So it's worth checking the market and seeing what rates are available.
The time is 7:30.
This is LBC.